In the US market, active fund managers have for quite some time failed to beat the benchmark consistently. That is a well-established trend. As the Indian markets also become more evolved and efficient, active fund managers are finding it increasingly difficult to beat the benchmark here also. As investors, what should we do? Should we then shift to passive funds and accept market equivalent returns? Within the human heart, however, hope springs eternal. And with the advent of technologies like artificial intelligence, there is a very real chance that machines will achieve what humans have failed to do. That is, beat the benchmark consistently. Today, to tell us how algorithms pick stocks, we have with us Kanika Agarrwal, co-founder UpsideAI, which is a PMS that runs several algo-based strategies. Welcome to our show, Kanika. How long has it been since you started UpsideAI? And could you tell us a little about the background of the co-founders?
Hi, Sanjay. Thank you for having me. Very happy to be here. Let me tell you a little bit about our journey. We started almost like a science project. The three of us, sometime in early 2017, started thinking about what we wanted to do. The co-founders have a natural skill set, which is investing plus technology. So just generally gravitated towards that space first, right? Atanu, one of the co-founders, got us to read Benjamin Graham, Intelligent Investor, blew us away, obviously. It's one of the seminal books on investing. We said, if Buffett or Graham, any of these guys were starting today, they'd all be technologists, right? Because they were so clear about using rules to invest, move away from emotions, biases, etc. So that was really the kernel of how we started, which is, can we teach machines how to do fundamental investing? And then, of course, it's evolved from there. It's not some value-bent, intelligent investor type story, but the thesis behind everything we build is to replace the human fund manager by using fundamentals, either company level or macros, but some logic behind picking stocks and not just technical parameters where you're trying to read price movement to make a decision. So we did this in 2018. It's the three of us that started this together. I am a CFA by training, started my career at EY, spent some time at Credit Suisse, and then I worked with Mayfield, which is a venture capital fund, doing early stage investing before moving on to the public side. Both my co-founders are from IIT Bombay. Nikhil is IIT Bombay, BTech in computer science, as well as he has a PhD in machine learning, also from IIT Bombay. In the middle of those two, he was at Credit Suisse on the algo desk, and then, of course, got his PhD after that. Atanu, third co-founder, again, IIT Bombay, BTech, MTech, and then he was in New York for many years working with a multi-strategy fund, doing some PE, VC. They did some SPACs also, before they became all the rage, and then, promptly blew up. But sort of the idea really, as you can see, we have complementary skill sets behind how we started this and what we're doing.
So why are human fund managers failing to beat the index? Why is this happening in your view?
Yeah. And this is not new. This has been happening for, the US has a longer track record of fund management. So if you look at that, right, Daniel Kahneman wrote a book, Thinking Fast and Slow, in which he talks about mutual fund managers in the US as well. And he said, if you go back and you look at 50 years of history in the US, picking a good fund manager is as good as tossing a coin, right? In any given year, they have about a 50% chance of doing well. So the main reason really, and that has translated in India as well, very, very similar, fund managers are very inconsistent in how they beat the benchmark. And the reason this happens is that usually, all of us have one way that we think, right? Our brain works on a certain track. And what that means is that, we have a certain style of investing, be it value, growth, commodities, any one specific style. We usually do very well when the way we think and the way the market thinks aligns, right? And then they promptly diverge. As soon as they diverge, there's a bunch of reversion to mean that ends up happening. And primarily, the static way of thinking, or the fact that we have enough emotions and biases involved in our own decision-making process, many of which even we are not aware of, is largely why humans are not great fund managers. Part of it's sort of that pursuit, right? We're all trying to figure out how to be good fund managers. But it's an unsolvable problem to my mind.
So one thing, according to you, is that humans have emotional biases, and also that their minds work in certain ways. They are good at certain things and not so good at other things. And when the market trend changes, they are not able to cope with that. So where does tech-based investing score?
Right. So, in the US, any hedge fund on the street worth its salt uses some sort of technology, right? So tech in investing is extremely mainstream as markets become more mature. Having said that, just because you use technology doesn't automatically guarantee that you're going to be a good investor, right? The average hedge fund in the US does as well as the average human. So the average quant hedge fund in the US does as well as the average human fund in the US, right? So they're all okay. Having said that, the outliers on really good performance end up being quant funds. So what that means is that your chances of success go up a lot when you're using quant, and the reason that happens is because largely it has no emotions, right? It has no ego. It's not worried that it'll be wrong. It's not very extremely happy that it's right. It doesn't really get scared in a market cycle. So of course, one is getting rid of the emotional part of it. And the second part of it, and therefore it allows you to operate within a system better. So one is, systemized rules. The other part is that it allows the rules to be dynamic. The second part of what we talked about with humans was that they think a certain way, right? They are one type of investor. As soon as you start using things like machine learning, like we do at Upside, what you're doing is you're saying that the rules are also not static. You have to be a good chemical investor at some point in the cycle. Sometimes you have to be a really good commodities investor. Maybe right now you should probably be a good large cap investor and know that you need to move away from small caps, right? So what quant allows you to do is be a lot more dynamic in setting or understanding the new rules of engagement, which is why we believe that there is an unfair advantage on why it can do well.
And we already have some kind of rule-based investing in India, like you have index funds, ETFs. Now there are an increasing number of factor-based funds coming in. How is your tech-based investing different?
So one is ETFs, index funds, they're here to stay. Okay, it's a beautiful system of using rules to invest and letting the market dictate what those rules are, right? It naturally, when you're investing in the Nifty, it's throwing out the losers and adding the winners, automatically every 6 months as the Nifty rebalances. That shows up in your index funds. So at a retail level, it's a great option to start investing. What we've seen in the US is that is exactly what has happened, where money has moved away from active mutual funds into ETFs and index funds now, right? And that's one part of rules-based investing as well. The second part of it, what you talked about in terms of factors, actually factors are the oldest form of quant. They've been around for a very long time. And the problem with factors has always been that it works till it doesn't. Right? Going back to the problem of being static. We talked about humans being static, but machines can also be static investors, right? They can be built on certain rules based on certain backtests saying, if this happens, then do this. Right? If the P goes to this of the market, then buy or then sell. But the problem is that, the market is this animal, it's changing. 20p today doesn't mean the same thing as 20p 10 years ago, right? Even that number has changed. Its importance changes. And therefore, as soon as you build models that are a lot more static, they will break down. And they end up giving quant a bad rap. That's why quant funds haven't taken off so much in India, because they were built on these factor models that are extremely static. So for us, when we started, we were very clear that you need to build dynamic systems that change with the market. So the reason to use machine learning is not because it's a cool, new age thing to do. It is because genuinely two things have happened over the last 10 years. One is data availability has exploded, and two, computing power has become extremely cheap. So this allows you to run far more complex models that can teach themselves. Even we can do it, right? Earlier, this would be inaccessible to regular fund managers. You need much larger machines. It would be extremely expensive, but this is available to us now. And therefore, you will see a lot more machine learning shops on Dalal Street as well. And what that will do is build more dynamic systems. It will allow quant to be a lot more mainstream than it is today, for sure. So that's the direction in which we're headed. I'm thinking factor investing is great. Great. It solves one part of it, which is it is rules based. It doesn't solve the other part of it, which is how to be dynamic.
Tell us about the style that you follow. Are you into technicals or fundamentals? Do you trade a lot, or are you buy and hold investors? Typically, what will be the churn ratio in your portfolios?
Sure. So, usually when people think of quant, they're thinking of someone doing high frequency trading or some form of technical analysis, right? Both of these imply a bunch of quick going in and out of positions, right? You don't hold for more than a week or something like that. For us, when we started, what we said is that you want to build an actual fund manager, the new age Buffett, right, which uses machine learning. And what that meant for us is to actually replicate but improve how humans invest. And therefore, for us, all of our inputs are fundamentals. Either we start bottom up, where we use P&L, balance sheet, cash flow data of companies, or we start top down and we use macro data, GDP, inflation, volatility, interest rates, things like that, to figure out either what are good assets to buy or what are good companies to buy in today's environment. And the idea is to buy and hold. So we do have a range of products that do different things, but on average, the churn is anywhere between, I want to say, 4 to 5 months to at least a year. That's broadly the holding periods for positions that we take.
Give us a sense of how the algorithm picks stocks. How does it really pick stocks? That is what our viewers will be most curious to know about.
Yeah, correct. So usually people think, oh, okay, it's a machine, it's God, it'll pick everything will do well. That's 100% what does not happen. For us, the process, really what we're trying to tell the algo is, can you figure out in today's market, what is our best bet for doing well? Okay, that's the problem we've given it to solve. So what it does is, right at the beginning, we pull P&L, balance sheet, cash flow, macro data, everything, put it into the system. It throws out a bunch of things. We don't consider PSUs. We don't look at fresh IPOs. We don't look at illiquid stocks. For everything else, it converts companies into ratios and numbers that any good analyst would look at. Right? Growth numbers, return ratios, cash flow metrics, debt numbers, valuations. So all regular fundamental metrics. There is no new secret multiple I have discovered, that didn't exist before. It's all normal stuff. The difference really for us, or the secret sauce where it kicks in, is at this point, anyone like a factor model or even a screener, they'll say, okay, let me filter on 20% growth, 20 P, 20 ROE, get a short list of stocks, do some work on them, and then buy another subset. So for us, what we're saying is, why 20? Why is this the magic number? Why does it apply in every market? Right? This filter that you were applying is different today from what it was 2 years ago in 2020. There was no growth then. Maybe growth didn't matter at all. Maybe valuations were important, right? Maybe safety was important. Cash on books was important. So markets are constantly changing. So these filters that you apply, what is the right growth number? What is the right weightage for growth? How does it talk to debt on the books? How does that talk to valuations? It's like a multi-sided problem that is constantly changing. And that's really what it ends up learning. So the machine learning part of it really keeps going back in time, multiple time periods, to try and build hypothesis, saying, okay, what if I look for stocks with this kind of fundamental profile? How would that do? And then based on how it'll do, it'll learn something, go back and pick another portfolio. So it's a self-learning process where it ends up looking at about 50 million portfolios. And with every portfolio it looks at, it gets a little bit smarter. So the next portfolio it's picking has a little bit more, intelligence. So the first portfolio it picked is completely dumb. But the 50 millionth portfolio, it's saying, okay, I'm smart enough to now make a nuanced decision on how to pick. Right? And then at the end of this process, it tells you, okay, I think I know what we should buy in this market. Here's a list of approximately 15 stocks. Here's the weightages in which you should buy it. We do corporate governance checks. We are buying and holding for longer periods of time. So we do try and make sure that there is no garbage in, garbage out happening. I'm not trying to take a call on what I think of cement as a sector. I'm just trying to make sure that I can trust the numbers for, say, Ultratech that we put into the system. Right? And then we buy and hold the portfolio that was suggested. And that's broadly what the process is. There is another overlay on top where we read macro data as well to figure out what should be in equity, what should be in debt, what should be in gold. An idea there is, to try and reduce volatility within portfolios as well.
So besides picking up stocks which are qualitatively sound, it also picks up where the market is headed. Is that it? Otherwise, how will it do well in different market conditions?
Yeah. So depends on what product you talk about, right? So there's two parts. One is we have something called the Upside Navigator, where we are actually doing asset allocation, right? There we are trying to take a call on where the market is headed, and therefore how much should you actually be exposed to equity? How much should you be safer in either government bonds or in gold ETFs, etc. It's a classic risk reward thing, right? There, of course, you're taking lesser risk because you're sitting out of equity a lot. So the idea is, can you beat the Nifty, but reduce the amount of volatility in the portfolio? And on the extreme end of that, we have a small and mid cap portfolio where we buy only equities, right? You'll buy a portfolio of 15 stocks or so. And what we have realized is that timing the market consistently is impossible. You cannot do it. People get it right maybe one cycle, maybe two cycles, and then that makes their career. Lots of human fund managers, but then the next one comes around, they're not able to. It's not possible. Buffett will tell you this. Howard Marks will tell you this. You cannot time the market, right? So for us, we say, okay, when you're doing buying stocks for people, they have given you their equity allocation. Your job is to buy the best stocks you can and then ride the market. Therefore, on that side, when the markets fall like they have right now, those portfolios also fall and they don't do well in bear markets, but they recover faster. So, for example, in March 2020, when the whole market fell 30%, this also fell 30%. But the next month, market went up 14%, our portfolio went up 22%. Right. So the same thing will happen within our equity portfolios, which is they will fall like the market, but go up faster. And that's how we think we will outperform. So it depends. It's horses for courses. Where you are on the risk reward curve determines what kind of portfolio from us you should buy.
How often do you rebalance the portfolio?
So some of them we go back and look at every quarter. Some of them we go back and look at every year. But the idea is not to do violent churns. Idea is to make small tweaks, go in and out a little bit, depending on whether something makes sense to hold or not.
And how many strategies do you run currently? And if you could tell us briefly about each one of them.
Sure. So we talked about it a little bit. We run 3 strategies. We run the Upside Navigator, where, like I was saying, we try and read macro signals to understand what should sit in equity, debt, and gold. And it's worked out. It's been a great time to actually start it. We started that in December last year. And what we've seen is, in 2020, when in our back test, it was saying to be 40-45% in equity. Over the last couple of years, it's been consistently paring that down, where right now equity exposure within the navigators, it's closer to 30%. And at the same time, it's been increasing what to do to gold, right? So that's really allowed us to weather the storm over the last 6 months very well. Nifty, from its peak is down about 15% or so. Our product is flat. So it's down 0.2%. Right. So it has, and that is really the promise of it, which is it's supposed to help you sleep well at night. And, as the Nifty moves up, we will also move up. And can you beat the Nifty, but get rid of volatility? The second one we do is the Upside 250, where we are buying a basket of good quality, large and mid-cap stocks. You buy and hold it for a year, and then that's it. You just buy, hold for a year, forget about it, come back, look at it every year. So it's long-term investing, buying high-quality stocks. Idea is, again, to generate, and that's done very well. We've been around for about 2.5 years. It's done nearly 20% annualized returns since we started on that product, just buying and holding good quality large and mid-cap stocks. And the third product that we have is our Upside Flexi Cap, where we buy across market caps, but there are only 100 large caps. So we end up buying a lot of small and mid cap stocks within that. And any given point of time, about 80-85% is mid and small caps. So till December, for example, that was doing a 25% annualized return. Over the last 6 months, it has dropped. And that will happen. It's part of the cycles that it goes through. And yeah, so that was the first one we actually started as a fund. That's again been around for about 2.5, 3 years or so. We've recently started dabbling in small cases. We do have a few that are live, and your viewers could go check them out. They're doing pretty well, but they've been around for only 2-3 months or so on small case.
One final question, Kanika. What is to prevent, if these machine and AI-based products do well, what is to prevent more and more players from coming in and kind of taking your competitive advantage away? So what is your secret sauce?
Right. So that it's two different questions, actually. One is, what is to prevent more guys from coming into the market? Absolutely nothing. Right. There should be more guys. I'm hoping there are more people who come. It is much harder to evangelize quant-based investing when you are, flying solo. It is the market grows. Right. And on the second side, which is taking our, cake away, there is not one Buffett, right? There are thousands of fund managers. Same thing in India. There are thousands of fund managers. Lots of investors end up investing with a manager whose style resonates with them. Right. And that the same thing will happen within quant as well. It won't just be one umbrella of quant. It will be guys who use quant to do different things. Now we're saying we're fundamental guys. Someone will say they're technical. Someone will say we are commodity guys, right? There'll be, just like with human fund managers, there'll be different quant styles that will evolve. And then you'll pick the one that works for you. The most beautiful part about fund management is that it is not a winner take all market, right? Even within the mutual fund side, you look at market shares of the largest AMCs in the country, they're max double digits, low double digits. So because you'll never trust one mutual fund house to keep all your money. You're always going to distribute it, and therefore there is place for everyone to exist, grow, and sort of learn from each other. So fingers crossed, I get more competition over the next few years.
Basically, let 1,000 flowers bloom, and you'll be happy with the competition.
Absolutely.
Thank you so much, Kanika. It was a pleasure speaking to you. I hope that your strategies do very well and more of the investors in this country adopt tech-based investing. Thank you.
Thank you, Sanjay. Thank you for having me.